Hey everybody, this is Brant from Wolf on Wall Street Trade with a market update for the week ending July 17th, 2020. Real quick, I didn't have a video out last weekend, but I almost always have a weekend update, so check the website. You can sign up for email notification when there's a new post. All that information is in the description of this video. I post them on Twitter as well. So I've been saying for a couple of weeks now that I expect the market to kind of be sideways. One of the main reasons is we're looking at the Dow here. This is the 50-day moving average, this is the 200-day moving average. So these are really the magnetic points of support and resistance, and the prices have just been sandwiched between them. So that is one thing. That's, barring anything crazy coming out of the market, these are the major currents that are kind of containing price. The other thing is we were going into earnings season. We just kicked off earnings season this past week with the banks. And typically going into earnings season, the market tends to rally and then tends to go kind of sideways into earnings season. These moving averages are kind of going sideways. And lastly, it's summer, the summer doldrums. We have very low volume in the summer. As a matter of fact, one day this week, I think it was Thursday, S&P's volume was like 30% less than normal. So for all those reasons, I just bring it up. It's not an exciting thing, expect the market to go sideways for a couple of weeks, but it's good to know because most stocks are going to follow the broader market. And all things being equal, if you know the broader market is kind of going sideways, for instance, I am not going to take big directional trades that I'm looking for big up moves or down moves. Or if I do take those trades, I'm going to give them enough time, how I construct them, I'm going to give them enough time to go through this earnings season and kind of just anticipate sideways prices. The market can do anything. I'm just saying the probabilities into earnings season with these moving averages in the summer favor a kind of sideways trend. That said, the week was really about earnings with the big banks kicking off earnings season. We did, however, get some surprising trade action, and we'll talk about that. So first, let's just start with the Dow since it's right here. You can see it's had just about a month-long range chopping back and forth between this 50-day and the 200-day over here since the May payrolls, which was right over here. We had a big change in character right there. S&P lost about 8%. Then we've kind of been sideways since then. Dow ended the week up 2.3%. You can see it broke out above this 200-day moving average where it's been rejected several times, but this 50-day has been acting as support. Here is the S&P 500. It was up 1.25% for the week. You can see Monday we had a really nasty day. This was all about the Nasdaq and the mega caps. We'll get to that. But let me point out this island top from the May payrolls that were reported in early June 5th. That island top gap has been filled. The mega caps were weak this week. They got sold hard, and that's a theme that we're going to discuss. But I want to mention this. S&P's up 1.25% for the week. Remember that the 5 top stocks is mega caps. They have just an overwhelming amount of influence on the broader average. So if you look at the equal weighted index of the S&P 500, it was actually up 3.7% on the week. But because those mega caps were so weak and because they have so much weight, they weighed on the S&P 500. Now, there is an interesting thing to talk about here with the S&P 500. This trend line right here at 3230.78 is the year-to-date unchanged mark. It's where it closed 2019. So you can see it was former support. Once it broke, it has now become resistance. This was the May payrolls in early June. So one day for about 10 minutes right over here, the S&P 500 went green for the year. This is just after payrolls. We had a big change in character. That changed real quick and the S&P lost 8% in the week to follow. So this is this week. And here is Monday. You can see it tested this level 1, 2, 3, 4, 5, 6 times this week. Okay, so that level was obviously an important technical level, and this was an options expiration week, so I suspect that may have had something to do with it as well. Here's where we came into the week on Monday. I said Nasdaq had a really ugly week. The mega caps, that happened right here as S&P went green year to date right there, and we had this nasty sell-off. The rest of the week was just kind of rebounded right here on a short squeeze in small caps and cyclical stocks, and then spent Thursday and Friday consolidating, right along this trend line and that year-to-date unchanged mark. Okay, here's the daily chart of the Nasdaq 100. This is Monday. This is a massive, very violent key reversal day. So it opens up here, makes a new high, and then closes well below the prior day's range. That's key reversal day. It's a very important day, technically speaking. As far as the stats, gaining over 2% in the morning and then closing down really bad, worse than more than 1%. The last time that happened was March 7th, 2000 at the height of the tech bubble. So here I've rolled back the Nasdaq 100's chart. This is the year 2000. This was the key reversal day at that point. So this is the worst this past week, the worst key reversal day that we've had since then. And this was March 27th when the market topped. So March 7th, we got that key reversal day, very ugly. March 27th, it topped and then spent the next 2.5 years in a bear market. And that's what it looked like. So we got a massive key reversal day. About 20 days later, a market top and a bear market. Here's what the Nasdaq 100 looked like on the week. So here's the gap up Monday morning. Here's the high up, significantly, and then just dumps. This was brutal. Spent the rest of the week in this consolidation, which has a bearish bias. We did get a negative divergence as prices were rising Monday morning. We also got a lot of really wacky signals coming from volatility Monday morning. So here's QQQ with a 1-minute 3C chart. This is Monday coming into this week, okay? So 3C was not confirming anyway, but we saw some negative divergences in other averages right here into these highs, and you can see what happened. This is why I think also this is a bearish consolidation, because 3C basically tracked with it and then towards the end of the week started negatively diverging, so a bearish bias there as well. Now, this key reversal day happened after the Nasdaq got some of its richest valuations, or let's say strongest relative performance versus the S&P 500 since the dot-com bubble here in 2000. And relative to the S&P 500, this was the Nasdaq's worst week since all the way back here in 2009. This is Amazon's daily chart on the week. Check it out. Here's the key reversal day. On Monday, Amazon was down every single day this week, down 7.5%. Here's Netflix. It had earnings this week, but before earnings, this was Monday. This is a major, ugly candle. It's called a dark cloud cover. Opens up here real strong, makes a new high, and then closes well below the prior day. Then it had earnings Thursday after the close, so it dropped down here, lost 10% on the week. As far as Netflix's earnings, it was one of those stay-at-home trades. Everybody's going to watch Netflix when they stay at home because of COVID. They had their biggest earnings miss in 16 years and the weakest subscriber growth in 4 years. That's actually forecasted going forward because they pulled forward subs. Here's Microsoft. There's Monday over there. Very ugly, down 5% on the week. And on a weekly chart, a bearish engulfing week. You could see it's the worst pretty much since the crash. And that's the same for the Nasdaq. It was the worst week since the crash. Google lost 1.5% on the week. And then here's Apple. It was actually up 0.4%, but kind of like a shooting star, and a key reversal day on Monday. So somebody wanted out of those mega caps really bad, and there was rotation. Now that rotation went from the momentum style factor to value. The value stocks are the beaten up stocks. They tend to be the cyclicals. So value outperformed momentum for the first time in 6 weeks, which was right over here. Value was kind of rotating in right into that payrolls report. Then we got that really nasty change, and they went back to momentum. They went back to the mega caps, and the mega caps have pretty much driven the market higher ever since. So that was a big change this week over here, very similar to right back here going into the May payrolls that were reported early June 5th. That rotation went to value stocks. Now you can have different style factors within the same sector, but generally speaking, the value stocks have been the growth sensitive cyclicals. Materials was one of them. It was one of the best performing this week, up 5.85%. It's a very lightly weighted sector, doesn't have a lot of influence on the broader S&P. So basically they're going from these mega caps to stuff that is more cheaply valued. Industrials was another one that was leading. Transports and utilities, that's a defensive sector. Also healthcare and the biotechs. The worst performing sectors were the ones that were filled with mega caps. So technology, here's a key reversal day in the technology sector, down 1.25%. And the communications sector. So here again, key reversal day, bearish engulfing, down 2%. So the theme was out of the mega caps, out of momentum, into the beaten up value stocks, which happen to be the cyclicals that are growth sensitive, that haven't done well. That happened to benefit small caps the most. So here is IWM small caps. Here's the 50-day. Here's the 200-day. They were up 3.75% on the week, right? After holding here at the 50-day moving average. Here's the 200, closed right above it. Remember what I said about the S&P's equal weighted index? It was up 3.7%. Very similar to small caps, which have no exposure to the mega caps. Even though small caps have underperformed the S&P horribly since 2018, this is their high back here. They haven't made a new high since then. They got that rotation, but they absolutely are not value. In terms of valuation, small caps are even more richly valued than the S&P. They're trading at 93 times forward multiples. So because the value sectors and value style factors got bid, and that benefited small caps, mostly because they don't have exposure to mega caps, this is not a value move into small caps. So from a technical perspective, this is good for small caps that they got above and held above the 200-day moving average 3 days. I want to show you some other technical levels that we've talked about and looked at recently. This is a big zone of overhead supply, about 145 for small caps. So let's zoom in. Now, the last time that we had the cyclical rotation or rotation from momentum to value was right over here into the June 5th payrolls, which I think was right there, right? So small caps did get above that for just about a week and then lost it. They've been bumping into that area. They got above it 3 days this week and held right there. So that's at 145 level. But we did see some resistance right here at this trend line. That's about 147.75. You can see, again, the last time we saw that rotation above, and then it's kind of been resistance. This is a major trend line. Let me show you. And this is a weekly chart. So this is the primary trend from the 2009 March 2009 market low. This is the decade-long bull market. Here's the break of it earlier this year. So this is a back test into that trend line. And on a daily chart, you can see small caps ran into resistance right there at that trend. VIX, the volatility index, this is a 5-minute chart. It was down 5.9% on the week, but super, super interesting as we came into Monday. Remember, the Nasdaq was opening up, making all-time new high. Everything was raging higher, but volatility was showing unusual relative strength. You can see it here moving up with the averages. That preceded that big, ugly day for the Nasdaq, the key reversal day. By Thursday and Friday, there was incredible sell-side pressure in volatility futures, and that just knocked VIX down the rest of the week. What's interesting to me is the exact same thing happened the week before. Started that Monday showing really unusual relative strength. The market fell kind of the rest of the week, and then into the end of the week, they sold it hard. So the exact same thing, just a little bit more extreme this week. VIX has been trading between this 50-day and this 200-day. So that selling towards the end of the week, and remember we had options expiration, the monthly on Friday, but that selling was really aggressive, and you can see it broke down below this 200-day moving average towards the end of the week on Friday. As far as the theme that was really supposed to be dominant, earnings season kicking off with the big banks. This is the KBW Bank Index. Really mixed earnings reactions. So you had JPM and Goldman Sachs up on the week. You had Wells Fargo and Citi and Bank of America down on the week. The banks have been trading horribly. That's why I've been short some of the banks like Wells Fargo. I closed that short the prior week for a gain, but they've been trading horribly. So one of the things that came out of earnings season so far for the banks was their loan loss provisions, what the banks are expecting moving forward. So you can see JP Morgan, Wells Fargo, Citi. Basically, I think this was record loan loss provisions that they made that were reported higher or as high as the financial crisis. So the banks are looking for trouble. Thanks to Tony A for this chart, by the way. So here's the KBW Bank Index on a daily chart, 50-day moving average. Here's the 200. So it was up as much as 4% on the week, ended the week down a third of a percent. Here's this 50-day moving average that it's really tangling with. This is where I got rid of Wells Fargo as my options were expiring. Now, as far as that rotational theme, if you're going to go into value and cyclicals, you would expect the banks to do very well. The banks did not do very well. So pretty much flat on the week, but as far as, rotation into all those other cyclical sectors, it was happening, just not here. And if we look at a weekly chart of the KBW Bank Index, it's very similar to small caps. So here is the last bull market. Here is the top of it in 2007. And this is the great financial crisis. Here's the 2009 low. So you can see this uptrend on this weekly chart, and this is where we are from March. So here's where we are now. I'm going to zoom in closer. It looks a lot like small caps. The banks tested above this trend line, just like small caps, for less than a week. This was the last time we had a strong rotation into the cyclical value sectors, the growth sensitive stuff, and broke back down below. So that's that trend line. So here's the bank index in the candlesticks, and this is the 10-year yield. You might recall that towards the end of 2019, the banks just started rallying, and I said, look, I'm not buying these. This looks horrible to me because yields are plunging, right? So this is the end of 2019. We have this huge divergence, and this is what happened next. So banks came down to what the bond market's reality was. So what I'm trying to get across is while we did see some cyclical growth sector kind of rotation, the bond market is not sending that signal at all. It's been moving lower since the payrolls report over here, which is also when the COVID cases in the US started re-accelerating to the upside. So next week, the regional banks start to report. They're a lot more sensitive to yields and to the shape of the yield curve. They don't have the trading revenue that the big banks have, and that is what saved the big banks this past week with earnings. They had record trading revenue. What the bond market did this week was just consolidate. So the yields, the yield curves, they just consolidated. So the 5-year yield was down 1.5 basis points. The 10-year yield was down 0.5 basis point. The 30-year yield was flat. So here's the crash. Here's what the 5-year yield has done since. Let me zoom in over here. This is from May, about the second week of May into the payrolls report. This is the one time where we saw that cyclical rotation, and this is where I said the market looked the best it has since the rally started from the March lows, because the bond market was starting to confirm, and that changed real quick. Okay, and then since then, it's been lower highs, lower lows. The last 3 weeks, like the market, you can see a consolidation here. This is a triangle. It does have a preceding downtrend, which means the probabilities are that it moves lower. As a matter of fact, if we look close, I think it was Thursday morning over here, the 5-year yield traded to a record all-time low, and then I think we got some news about a vaccine or something, and they bounced back up. But the point is, like the market, they've been consolidating, and they have not been sending the kind of signals that would suggest that we're seeing economic growth pick up and we see these value sectors rotate in. This is a 5-minute chart of the S&P 500, and this is the 5-year yield in white. This is the last time we had really strong confirmation from the bond market, and we had cyclical rotation into these value sectors out of momentum. Okay, this was kind of like a growth signal. The market was saying we expect economic growth to pick up. Payrolls were reported right here, and then things changed real fast and yields led lower. S&P lost about 8%. You can see what's been going on here during this consolidation between like the Dow's 50-day and 200-day ever since this happened, is that yields have been making lower highs and lower lows. They've been negatively diverging with the market. So they are not sending the kind of signal they were over here, kind of excited about economic growth, and that faded real quick. It didn't last very long. But they have been consolidating right here, as you can see in this little triangle. The banks are much more sensitive to what the yield curve is doing and to what yields are doing, especially the regional banks. So let me pull up the regional banks and show you the difference. You can see they've pretty much been following yields. We had a little divergence here, and I was looking at maybe selling short. Didn't quite get there. I'm looking at it into next week, but you can see they're very, very sensitive to what yields and what the yield curve are doing. Banks touch every part of the economy. You have to remember how ugly these things have been trading. So here's the S&P 500 again, and this is the yield curve. So it's the 5-year less the 30-year, the spread. Again, this is that period from the second week of May or so into payrolls. This is sharp steepening. The banks love that. This is giving a strong economic signal. It changed real quick starting the day of payrolls, also when COVID cases started spiking again. Again, what is it doing? It's flattening over here, making lower highs and lower lows and very divergent from the S&P 500. The banks, here's the regional banks. You can see they're much more sensitive, economically speaking, to what's going on, at least what the bond market is reflecting. Now, I want to show you something that I've pointed out before. When you're going to get an economic recovery, the bond market usually is the first one to sniff it out. And the bond market pretty much doesn't lie. You just have to pay attention to what it's saying. So let me show you something real quick. So here's a daily chart of the S&P 500 from 2007 to 2009. There is the October all-time high top. And here's the financial crisis. There is the market bottom, the start of the new bull market. I'm going to add the 5-year yield, and here it is in white. What did it do? It led the market lower. It saw problems. But let's look at the bottom over here. So here is the March S&P 666 bottom. I'm not kidding you. But here is the 5-year yield. Look what it did. It made higher lows 3 months in advance of the market. 3 months before stocks sniffed out the bottom. Yields had already done that. Let's move forward to today. Again, what happened over here? Yields led the market lower. They could tell, they knew there was a problem coming with COVID. The commodity market did too, the currency market too. They were all screaming. It was only the stock market that was ignoring it. But since this recovery on Fed liquidity, what has happened here? Are yields leading? Are they even confirming? No. The 5-year yield, like I said, early this week in pre-market made an all-time record new low. Let me touch on gold real quick. This is GLD, and it's a 60-minute chart. You might remember back here in March, gold's volatility got insane. And I said, look, I'm not going to even mess around with gold. I like gold, but I'm not going to buy it until the volatility came down. It finally did come down, and we got into this huge consolidation. I've been constructive on gold. I've liked it. So let's take a closer look. So here's GLD. It had like a little false breakout, then consolidated some more. But ever since then, it's had some really constructive, like bullish flag, a little bullish pennant here, a ascending triangle over here, and now we're in a flag. So GLD has been up 6 weeks. I chose to go long gold miners instead of GLD, which has worked out better. But before we get to that, GLD, our gold, is consolidating over here in what looks like a small bullish flag. Here's that bullish triangle, breakout, bullish flag. This is very constructive price action. I have no problems with it. GLD was up 0.5% on the week. GDX was up 2.4% on the week. Let me just back this chart out a little bit. So 60-minute, kind of the same thing. Finally showed some bullish price action over here, and I got long on the 26th, which was right after this bullish price action. Let it consolidate, come down, got long right here at a touch of the trend line, and my target was 38.75 for this first leg. When it got there, I had more than 100% gain or double. So I took off half the trade, paid for the trade, and let the profits run. So I have no risk whatsoever. So GDX, same thing as gold, big bullish flag over here. And it started to break out. So it's looking for gold to break out. But it started to break out from this. And if you're a member, you know I've got higher upside targets, and I'm sticking with this trade. GDX has been up 5 weeks in a row. It's been up every week since we bought it right here. I'm also long GBTC, the Grayscale Bitcoin Trust. It's just a way for me to play Bitcoin. This is a huge, huge consolidation. It's taken a lot of patience. That's why I didn't want to get leveraged like crazy on it. I want to give it some time. But in my opinion, it's a bullish consolidation. It looks like a big bull flag. And I really came into this position understanding it was going to take some patience. Let me show you where this flag is taking place. So here it is, and you see this trend line coming in right around 11. I'm going to back this out on a 2-day chart. You're looking at a 60-minute chart right now. So this is pretty much about a 2+ year huge, huge consolidation. This is where that little bull flag is. This is a 2-day chart, by the way. So the reason I'm in this trade is because if we get a breakout here, the upside potential is insane with this big of a bullish consolidation. But like I said, I came into it understanding that, it was going to take some patience, and, I'm just going to sit with it for now unless I see something to change my mind. But so far, I like it. Consolidating bullishly right below this major, important trend line. So to wrap this up, again, it's earnings season. We have these major moving averages here, and prices just kind of caught between them, a little bit above, a little bit below here and there. But the point is, I kind of expect the market to kind of trend sideways. We'll get some up days, some down days, some up weeks, some down weeks based on earnings. But until a theme emerges from earnings, I think the market is just going to kind of sit here and see what comes out of these companies. This is why I say I've been looking for market signals like that USD JPY plunge right over here. S&P lost 8% in the next week. If I see those kind of signals, it doesn't matter if it's earnings season to me. I'm in. I did open a short trade in, this is FXI China 25. So China had a state-run media article talking about, supporting the bull market, and all these retail traders came in. So I faded that. I went short FXI right here. That was July 10th. I bought puts in that. Here it is on a weekly chart. So we had a doji star and down about 4.5% on the week. Here it is on a 30-minute chart. So this is that article, and all these retail traders flooded in. Here's where I shorted it on the 10th. And if you look at the price action ever since, it's falling, putting in a little bearish consolidation, falling again. So I saw no reason to close that short. I left it open, and I gave targets for members, but I'm pretty much looking for at least this gap over here to be filled. This Nasdaq key reversal day, in my opinion, was a very big deal. That's a very, very ugly candle. It was a very violent reversal. We've seen a rotation into the beaten up cyclicals, the value stocks. And what I've been saying this week is it's one of two things. It's either the market sees these stocks as overvalued, which they are extremely overvalued, and they're a little bit concerned about it going into earnings season and decided to park their money in something that was less overvalued. That's why I think they're moving to these value sectors. Or they believe that the economy's about to accelerate, and that's why they're going into the value cyclical sectors. But as we saw with the bond market is not sending that kind of signal at all. This entire run of new highs was 5 stocks, basically 5 very heavily weighted mega caps. And as this was happening, market breadth really, really deteriorated. So here's an example. This is the Nasdaq 100, and this white line is the percentage of the Nasdaq 100 stocks that are trading above their own 50-day moving average. So this is the 2020 high. Here's the crash. You can see what happened in early 2020. It was those 5 stocks that were driving the entire market higher, while most of the other stocks were not participating. We got this negative divergence. It doesn't mean the market's going to crash, but it does mean that if the market does pull back or starts to sell off a little bit, because there's so much damage already under the surface that you can't see at the index level, they tend to be worse. Same thing happened over here. So my point being, those mega caps breaking down this week is a major event, because there's already a lot of damage under the surface that you can't see at the index level due to their weighting. This is a 60-minute chart of QQQ. Since like late April, it has been trading almost in this perfect channel. Here is that key reversal day, kind of a bearish kind of price consolidation the rest of the week. So I think the probabilities are that it does come down and test the bottom of this channel. But a lot of times I call these channel busters. If you get a move outside the channel like this with a lot of momentum and it fails, a lot of times it will break down below the bottom of that channel. So that's something to watch this week. Also, this whole value cyclical rotation, whether it is just, like I suspect, just people moving out of very, very richly valued stocks and into some cheaper, at least from a valuation perspective, stocks in case earnings season disappoints. But who knows? It could be a rotation, so we have to be on the lookout from that. But watch the bond market to confirm or not. Speaking of valuations, the Federal Reserve's Vice Chair, Randy Quarles, this is what he said this week. This was in a note to other central banks. We may be seeing significant pricing disconnects between the market and the economic fundamentals, which could result in a sudden and sharp repricing. This is what the Fed Vice Chair, number 2 guy, sent out to notes to other central banks this week. Meanwhile, if you look at the equity put-call ratio, traders are the most complacent they have been since the dot-com bubble. And that while we have massive unemployment. So yeah, unemployment got better when people went back to work, okay, because it spiked up here. But look where it is now. This is continuing claims, people who are still getting unemployment. I mean, look where we were at the dot-com bubble, at the financial crisis. This is insane. So we're talking about insane valuations with people unemployed all over the place and market participants being the most complacent they have been in 20 years. That's not all market participants. This is the CBOE skew index. It's also called the Black Swan index. Okay, so high readings mean that people, professionals, are hedging against tail risk. Tail risk is black swan risk. It's unknown risk. So look at the levels that we're trading at, even this week over here. These are like nosebleed levels. Just for comparison, this huge spike was just days before the market started to crash. So while the retail crowd and everybody else is super bullish, you're seeing professionals here taking some precautions and buying deep out of the money puts as insurance. Not everybody is complacent. And with that, this video has gotten really long. I made up for last weekend. Thank you for watching. If you enjoyed it, please give it a thumbs up. And if you have questions or comments, please go ahead and leave them in the question comment section. I'll try to answer as many as I can. You can follow me on Twitter, so check that out. Check out the website. You can subscribe for free emails, or you can become a member and subscribe. And with that, I am going to leave it off. Wish everybody a happy weekend. And members, if anything funky is going on in futures, Sunday night, I'll have an update. Otherwise, I'll see you Monday morning. Have a great weekend, everybody.